All right, does that work? Yeah. All right. I guess the software decided to change the settings on its own. Is that artificial intelligence? Hey, good morning, everybody. Como allez-vous? How are you? Welcome to Trade Non-Farm Payrolls Live, a collab between FXStreet and FX Bootcamp going back 204 months. My name is Wayne McDonell. I will be your host today. I'm the Chief FX Market Strategist for TradersWay.com. I'm the Chief Economist for QuantBox.com. I'm the, what do you want to call me? I'm a lead coach for FXBootcamp.com. And what else? I think that's it. So good morning to you. Happy Easter. It's a great Friday if you ask me. That being said, let me remind you that trading is risky, not appropriate for everyone. You know what? I'm supposed to show a disclaimer, and I do have a disclaimer now somewhere. Created one the other day. It's this one. It's, is it going to bring it up? The National Futures Association wants you to actually show the disclaimer. This is under my Quant box branding. Anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So once again, guten Morgen. How are you today? I hope you've had a great trading month. I hope your first quarter of the year was fantastic. And this is the first NFP of the second quarter. So, well, we have lots to talk about today. One of the things, obviously, that's important over the next, as far as direction for the market over the next few, how you say in English, next few weeks maybe, will be this non-farm payrolls. So what is it that we're looking for? Well, have the efforts by the Federal Reserve Bank of the United States of America starting to take effect? Simply it. And if they are having a positive impact based on what the strategy was, does the current strategy need to change? We've slowed down from 50 to 25 basis points, and now can we pause? Or are we going to pause soon? And so now, today is the day you hold your breath in anticipation of, oh my God, that the numbers can show that things are starting to work. The numbers can show that things have yet to start to work, and we don't know which. Okay? And so now that's what we have to pay attention to. A lot of people have put money to work based on what they already believe is going to happen, but yet nobody actually knows what the number is going to be. Now, you can say, well, Wayne, they've done their deep dive research. Okay, that's cool. Right on. But let's think of it this way. Do you understand how non-farm payrolls is even calculated? They call a few thousand people, ask them some very, very, very basic questions, and from that, they extrapolate an economy of 330 million people. Let me say that again. Okay, they talk to a few thousand people over the telephone and extrapolate 330 million out of a few thousand. Holy smokes, eh? So there's, how could you have the right number when that number seems to me is highly volatile just by how it is derived? So you might be right in your calculations, but that may be different from what the Bureau of Labor Statistics comes up with. And so there's still a huge margin of error. Think of it. A few thousand people, wave your magic fancy math wand, and then you can say, oh, well, this is what 330 million people are doing. It's a bit of a stretch, don't you think? So the margin of error is there, and it's real. So one of the things we could look at today is the revision and all that kind of stuff that we've been looking at in the past. But I don't think that matters right now. We're not interested in reality. We're interested in predicting where we're going to be in 3 months. And so now we're leaning. So last month and the month before, we were leaning on the revision. This month, I don't care. I don't think we care about the revision. We care about the headline. I know, topsy-turvy world, right? Topsy-turvy world. Well, they filmed Stranger Things right next to my house. So, so the Upside Down, was that what it was called? Yeah. So now we care more about the headline because we want clues that describe what the next 3 months are likely to be. So we're now all projecting. Okay. Now, to add maybe insult to injury, today most of the markets around the world are closed in observance of Easter. So we have a thin market. What that means is there's not as many market participants as we usually have. In fact, there's significantly less. That means your technical analysis is less reliable today because technical analysis is a self-fulfilling prophecy. If you're going to trade some sort of technical analysis, some technical setup, it'll only work if everybody else is doing that too. But if there's nobody there today, or very, very few people today, those that disagree with the majority, so they buy where you're supposed to sell, or they sell where they're supposed to buy, they have sort of, let's say, more influence over the market, and you don't get the self-fulfilling prophecy. You get potentially gobbledygook. Or what could happen is the markets can be exaggerated. So imagine the whatever currency pair you're going to trade today jumps 50 pips and then drops 50 pips. So the volatility could also be higher. No, I didn't realize my charts are off there. Let me redo this. Okay, so you are risking today potentially the market's not behaving the way that they normally do or the way you would expect them to. And or they potentially could be more volatile than normal. Volatility is bad. Remember that? Remember in calculating your Sharpe ratio? You want consistent returns with low volatility. Oh, well, Wayne, today is a high volatility event. Is that good or is that bad? Okay. So anywho, why don't we, it is bad, right? So here's what I'm trying to say in English. Be careful today. Don't do something stupid that hurts your account. What I would recommend to you as a trader is that today can offer some great opportunities on the short term. That's what volatility can do. You might have an opportunity, some scalping and stuff like that. Or this could be the very beginning of a really nice trend. But we won't know until after it occurs. And then if it's only volatility that we get today, then it'll go up and then down, or then down and then up, and then it'll pause or reverse or whatever, and it's meaningless on the long run. Okay? But ideally, we get a trend out of this. And in that case, you could trade it, let's say 5 minutes after the news, 15 minutes after the news, an hour after the news, 4 hours after the news, a day after the news, and it'll be fine. It'll be fine. You're not going to miss anything. If there's a trend, if there's a fundamentally based trend that comes out of today because the number is really, really big or the number is quite small compared to what we've been getting, well, then we get a trend and then it doesn't really matter. You can wait till Monday when there's almost no volatility. It's okay. If today sets a new trend, that'll probably last the next few weeks. So you don't have to be in it in the first 5 minutes. You see? Stay small, stay humble, focus on the long term. This is what I say. Okay? That's what I say. So the markets right now are generally flat, except for a few things. Oops, whoa, hey now. There we go. What I want you to zoom into, will it let me into that corner? No, it's too smart. It's so smart it doesn't work. Let's do it this way. Will it work? You are the one. Hang on a second. Only you beneath the moon and under the sun. I just want to blow this up because I don't know how this is coming across with the stream. How my torment is through. All right, so let's get in there a bit. Okay. And this is a quick glance into what's happening right now. This updates in real time. Okay. And you can see NASDAQ and the FTSE and the DAX and the S&P 500 are all doing good today. And my fundamentally based service, this is Quant Box. It's an AI sitting on the Google Cloud, pulling data from private and governmental websites, and then comparing and contrasting them with other assets. Okay? What this is saying is, now I got to zoom in again. What this is saying is the FTSE, the NASDAQ, the DAX, the S&P 500 were all expected to go up, and they all went up. Today. That's really cool. Now, some of them, like FTSE and NASDAQ, went up a lot more than what you would expect. But up was expected, and they did go up. Okay? And then these things down here, CAD Swissy, CAD Yen, oil. Okay? Okay, these were all expected to be bearish, and they're somewhat bearish, not very bearish. See, these things were expected to be bullish or bearish, and they're slightly bullish. These were expected to be bearish, and they're slightly bearish, right? See, right? Like these over here underperformed. These performed okay. These things over here were expected to be up, but they're down, but not much. Okay, like there's just really nothing in the currency markets really dramatically happening today. The only thing that's happening in the moment are the global stock markets seem to be up, and that was as expected. These things were supposed to be up, but they're down. Okay, these things were supposed to be down, but they're up. These are down and they're supposed to be down. And these are up, oops, and they're supposed to be up. So you're like, really, if this offsets this and this is offset by that, then as a whole, as an aggregate, today, right now, not a lot's happening. Now the stock markets are up because yesterday was the last day to trade the stock market before they closed for the Easter holiday. So maybe they're up because people were forced to buy today. Okay, so for example, now what I could do over here, oops, come on now, there we go. I can get rid of commodities and indices, okay, and just look at the currencies, and it's a mixed bag, okay? Not a lot going on in the moment. Okay. A lot of cross pairs. Okay. Underperforming. Only do majors now. And sort of, again, mixed bag. Very, very close to the waterline. Burp, burp, burp. So anyways. And that represents a market in which many of the markets are closed. The market conditions show that today we have sort of meh, and that is bad. Well, I shouldn't say it's bad. It presents a higher level of risk than normal. So I'm asking you to be cautious. Okay? Now, another way of looking at this, let me zoom in here. I want you to notice this, even though you log into Quant box, that the actual database is sitting on the Google Cloud. This is not a web page. We're not pulling up images. It's actually doing calculations as you are looking at it. So what I want to do is look at the heat map here. Okay, all right. So we're not pulling 10-year T-note for some reason. Okay, so we're not showing the yields. Everything in dark blue, blue or dark blue, is moving up right now. Everything in pink or red, and there's no red, and you're like, what red? I can't see the red, Wayne, is bearish. So the biggest loser right now is only down 0.25%. The biggest loser is down 0.25%. Chump change, right? Now the biggest winner, as I showed you before, right now is the FTSE. It's up 1%. NASDAQ's up 0.75%. DAX is up 0.5%. But then the best currencies, so again, if we just do currencies, let's get rid of indices and commodities and only do these currency pairs. Okay, the biggest winner is up 0.5%. The biggest winner is up 0.5%. And the biggest loser is down 0.25%. Another way of saying it is it's a big fat flat, if there is such a thing. So be careful. I've tried to show you 3 different ways now to show that your risk today is higher than normal. We're overly sensitive to what the number is going to be, and many market participants outside of Forex can't trade it. So higher anticipation and lower market participation. So high anticipation, low participation, aka risk. Please be careful today. Okay? Give me a thumbs up or a yes or I don't know. Type something. Thank you. Muchas gracias. Hundo P. Cool. Yeah, that makes sense. How am I? I'm wonderful, thank you. How are you today? So let's take a look and see how the world is sitting. Let's find another way to describe that nothing's happening. Let's look at currency indices. Okay. Dollar is still on support. Swissy is strong today. Yen is sort of strong-ish, kinda. CAD is back on track for losing. Kiwi and Swissy, really, we need to add more data. We're zoomed in way too much. Okay, Kiwi on the long run, not doing that well on the long run, right? We have some Swiss franc strength, and it's somewhat kind of trending. Pound trying to keep in the game here. Hasn't really changed much. You can see on the short run, it has made higher highs and higher lows. And Aussie's getting crushed. So dollar kind of on support. Okay. Yen hesitating, waiting for the next Bank of Japan meeting. Swiss franc thinking about going strong? Mixed bags. Okay. So like, let's say if I gave a click in here for dollar, okay, it looks like dollar's going down, Swissy's going up, and yen's moving sideways. So even our funding pairs lack congruency. Okay. Will there be any volume? I just talked about that for 5 minutes. Andelo. You'll have to rewind the tape. I'm already out of coffee. Oh my gourd. So that's the longer term. Do you want to see the shorter term? Sure, Wayne, just the shorter term. Okay, Swissy strong. Pound flat. Aussie bear-ish. Euro up. Okay, let's squeeze this in here. Okay. Okay. So what would you say? How would you describe all of this? Let's delete. What would you say for this one? Well, up. Okay, what would you say for this one? Down? Okay, cool. Now, this pair, euro-dollar, now this is the dollar index versus the euro index, but if you compare the euro index to the dollar index, euro-dollar, that represents 40% of the entire foreign exchange market, according to the Bureau of International Settlements. The BIS is a central bank to central banks, and central banks are banks to banks. I know, right? All right, so anyways, that's that. Swissy appears to be strong. And would you say yen appears to be strong? Yeah, strongish. Cool. Now, a strong euro, weak dollar, strong yen has all been predicted. Yeah. It's all been predicted. So what are we left with then? Let's kind of look at something else. Okay, let's look at something else. We have CAD coming down, Aussie coming down, Kiwi coming down. Could that be commodities coming down? Yeah. Yeah, you could isolate it in a simple form. And then what about pig? Not up. Okay. So once again, mixed bag, no clarity, and it's another sign of being careful. Now, when we go through some of these charts, what you might find is that there's technical rationale, not just fundamental rationale for some of these things. No, maybe I'll go to the dollar pairs. CAD yen, maybe not the greatest example yet. It's looking good though, huh? This might be an example. Okay, so we have Kiwi coming down. Do you remember that? And we have yen going up. And this is yen, by the way. Don't know why. It's over there because I had to shrink my charts for this live stream. Anywho, you know what that red zone is up top? This is the price range in which a bear would start selling for the month of April. Okay? So the only way to make the mud clear is to get yourself out of staring at these candles and going, oh my God, it's not giving us any direction. You might be on a you might be on a 5-minute chart here or a 15-minute chart, and you're saying, hey, over the last 24 hours, it's done nothing. You see what you're missing? You're like, oh yeah, it's done nothing, but it's falling and it's going to fall for weeks. Okay, that's the part you might be missing. It hasn't done anything today, but it's going to fall probably tomorrow, the next day, the next day, the next day, the next day to the next day. Now we know if it does fall, it's not going to fall like this. But that in general terms, that's the direction. What we call strategy. And from here is, if that is correct, then we know tactically it's going to go lower low, lower high. Okay? And then you're going to drag this across. And that's going to act as resistance. And then it's going to make a lower low. Okay? So then you're going to drag this across. And it's going to go up, make a lower high, and then it's going to make a lower low. And then you're going to drag this across. Okay? Lower high, lower low, and then what? Well, we don't know what's going to happen here. Okay? So this is what you might see on 15-minute candles, but strategically, well, that's sort of irrelevant. If you don't have this as your strategy, everything else is nonsense. You can't predict the future. And if you can't predict the future, you're going to be locked in foreign exchange poverty for a long time because it's your job to predict the future. That's what we do. You have to know absolutely everything globally and then accurately predict the future every single day. That's your job description. Okay? What will it look like if I'm wrong on this Kiwi yen downside? Well, it's fairly easy to understand that. The buy zone is probably in here. It's funny how thin that got. All right, let's do this again. The buy zone is in here somewhere, right? So what's a bull going to do? Somewhere down here, probably the next wave down, it starts doing this. Hua. And what do? I get stopped out. Wah, wah, wah. It's okay, bro. It's okay. It happens. But the thing is, if I know my strategy, then I can predict the strategy of my opponent on the other side of the trade, right? Right? Right. Does anybody have questions about this? Adrian's like, I'm new to fundamentals and learning more. Cool. What would have provided clarity on an ideal NFP day that could be traded? Well, you're talking about news, Adrian. News. A news release like non-farm payrolls is not fundamental analysis. Okay? So like what I outlined here, this Kiwi yen trade, would last the entire month of April. So NFP coming out today will only add volatility in the short run, and that only offers a scalping opportunity. Well, that's not fundamental. You're just trading the vol. It's a vol trade, volatility, not fundamental at all. Okay? Now the next part is, how does NFP fit in fundamentally? Well, it actually is more important not as a headline economic number. It is much more important in terms of behavioral finance. Okay. Okay. Much more behavioral. Now, is that fundamental? It's closer to fundamental. The reason it's behavioral is professional institutional traders are making decisions today based on what they believe to be the probable outcome of economic conditions, more specifically monetary policy, 3 and 6 months from now. So an amateur trader is looking at what happened today, 2 hours ago, yesterday, and they're trying to make 50 pips. They'd be tickled pink to make 50 pips off of non-farm payrolls. An institutional trader is trying to figure out what the stock market's going to do in September. And I'm not even joking. Like, that is the major disconnect between an amateur trader and a professional trader. So they're like, dude, go ahead, pick up your 50 pips. Okay? See if you can get it. Good. But we also know that same trader, because think about what you're doing today. If you're trying to make 30, 40, 50 pips on non-farm payrolls today, think about what you're doing. Your entire business model is based on trading the highest risk, lowest reward market conditions possible. What's the likelihood that you're going to have low volatility and consistent returns in your results? Well, what? 1 out of a million? You know, somebody might be able to do it, but probably not you. And if you rounded it, as Jim says, it's 0. Think about what an institutional investor does. Not trying to pick up 25, 30, 40 pips on a high volatility, thin market trading on non-farm payrolls during a holiday. Like, it's ridiculous, right? It's laughable. So anyway, trading the news, aka scalp, high volatility, event-driven strategy. That's what I've called, like, think about it, guys. This is my 204th non-farm payrolls that I've done visibly with FXStreet in a row. You're like, 204 months. Do you understand that that's 17 years? Okay? 17 years. That means if you adopted a puppy, it's dead now. That's how long I've been doing non-farm payrolls. And the whole time I've called it a high volatility, event-driven strategy. But it's not fundamental. So be careful, be careful, be careful. I'm happy if you can pick up 30 or 40 or 50 pips. That's great. But on the long run, at the end of the year, it's irrelevant. So I'd much rather you focus on the fundamentals. And the fundamentals today is going to be highly sensitive to the headline number. Last month I said it was the revision number. This month I said it's the headline number. Because we are trading behavioral finance related sort of topic, if you will. What is the Fed going to do 3 and 6 months from now? So let's talk about that and then we'll move on. But I want you to take this, what I just outlined with the Kiwi yen. You should be able to do this with every single pair that you do. Now, I do this with people at FXBootcamp.com. Teach you how to do this. Okay? Okay? But I'm not interested in the high volatility event-driven strategy. It might be fun, but whatever. Okay? If I get short Kiwi yen, I'm going to be short for 4 weeks. You might be short for 4 hours or 4 minutes. So you do you, I do me. Okay? Okay. All right. So let's talk about the behavioral finance issue. Okay. A few months ago, we did a number and it was 500K for non-farm payrolls, right? So let's do that. What's the likelihood that non-farm payrolls comes out 0 today? Zero. Let me get the FXStreet number. Does anybody have the FXStreet expected number for NFP? Cool. 240. Okay, cool. That works out nice. All right. All right. So let's go back. So we'll do a median. We'll do it as expected. That represents median. Okay. 250K. All right. So check this out. The high was 500. And that creates dollar strength. So let's do a standard deviation. I'm not going to calculate the standard deviation here, but I can do, okay, I can calculate the mean of the last 12 non-farm payrolls, and then I can calculate the rise over the run, which is the slope of the mean. And then from that, I can calculate the variance from the mean, how far price tends to move up and right. And then I can take the square root of the variance and I can calculate the standard deviation, which is the square root of the variance of the slope of the mean. So I can do it, but I'm not going to do it. Okay. So what I'm going to say is, let's throw a number here. If the number, if the headline number today is above 300, let's say, which is just, let's say, significantly higher than expected, okay, USD goes up. Okay, and if it's less than 200, USD goes down. Okay. You got that? What do you stink? Smell like a plan? Now you might say, well, shouldn't we look at this and shouldn't we look at that? Yeah. But when you look at things like the unemployment rate, you have to look into why did the unemployment change or not change, and it very often has to do with participation rates. And so very often I think you'll get a trade on, let's say, oh my God, the unemployment rate went up. And then you trade that and then you find out, oh, but the participation rate also went up, and then that trade collapses on you. Okay, so that's the primary thing we're looking at. The secondary will be last month's revision. And do they revise the number up or down? If they revise it down, that could offset. So we'll put this as maybe, this is an 85-15% ratio. So we'll look at the revision, which represents only 15% of the trade. If the revision from last month is lower, but the number is higher, they offset each other. But if the revision is lower and this is a lower than expected number, then the dollar gets really weak. But the vast majority of it's going to be headline. What you want to be careful of is the cross winds, where the revision does dollar strength and the headline does dollar weakness. And that's where you get your high volatility, which means up 50 pips, down 50 pips. And remember, and the reason I warn you about the risk is in a scenario like that, slippage risk is higher than usual, a lot higher than usual. Spreads widen much higher than usual. And you're probably late. So on top of that, there could be, let's say 10 pips of slippage, 15 pips of spread, 25 pips of movement. So by the time you get in, it's already moved 50 pips. And then it drops 50 pips and you're out. And you get a big fat loss. And then you're like, oh, but my broker traded against me. No, you suck as a trader. That's the issue. You've picked the worst time to trade with the highest level of risk, and you decided to go big. It's not your broker, it's you, bro. Look in the mirror. Okay? So anyways, that's it. So those are all the things. Yeah, crosswind, right? Learning to fly, but I ain't got wings. Okay? Now, why does your broker jack up your spreads? As an amateur would say. Oh, they're not. Remember, your broker gives the trades, assuming that they're an ECN like Trader's Way. Okay? For those that have ECN accounts at Trader's Way, what happens is your trade goes immediately into the liquidity pool. There are liquidity partners. Think of them as all the banks around the world, or most of them. You're like, oh, that's the interbanking system. Yeah! It's not your broker. So let's say you're a trader and you trade 1 second after non-farm payrolls comes out and your spreads widen from 2 pips to 20 pips. Is it your broker? No, it's you. There's nobody else in the interbanking system that is dumb enough to trade except you. So the orders to fulfill what you just did, which you click buy or you click sell, the nearest order has already been set, probably using limit orders before the news came out, 20 pips away. The trade that you're asking for, the closest one is 20 pips away. And therefore, you're matched, but now your spread is 20 pips. It's you. It's not your broker that says, everybody pays 20 pips in the next 1 minute. No, that's not how it works. Okay? Especially on an ECN, because your trade just gets thrown into the interbanking system. So that's what happens. It's a sign that you're picking the worst time to trade when nobody else is willing to do it, just you. If there was liquidity, the spreads would be narrow. Sometimes on Trader's Way, I get like 0.1 or even 0 spread because it's so liquid. So if you trade in an illiquid market, the liquidity, you're stretching out to reach the highest fruit. You got to stretch your arms, son. Okay? Okay, so we have about 3.5 minutes. So let's zip over. I'll do dollar pairs because most of you guys are dollar pair traders. And I'll do euro dollar because most of you are euro dollar traders. And we are currently on this 4-hour chart, definitely in an uptrend. So I could argue right away, no matter what happens, I don't sell. That's probably the safest way to play it. So if it drops like a ton of bricks, who cares? What do you care? It'll probably be up tomorrow. How do I know probably? It's an uptrend. Think of it. Higher highs and higher lows. The probability is it'll continue making higher highs and higher lows. But if the number is redonkulous and it's the end of the uptrend and we got massive dollar strength coming, I can catch it later today. I can catch it on Monday. What's the big deal? I've been sitting here for 20-something years. I'm going to be here on Monday with lower volatility, a clearer trend, a better setup, okay? Lower vol, better spreads, and a trend that'll probably last 3 or 4 or 5 weeks. So, like, what's the big deal? Do I have to be on the trade today? Okay? Andelo, please don't do that. I don't like that. Please don't do that. Okay? So anyways, so if you need an ECN account, for example, guys, where your broker doesn't trade against you, try tradersway.com. I recommend them. Okay, we're just seconds away. If you get the number, please let us know. And I'll zip into a smaller time frame here. Look how wide the spread is all of a sudden. Now, this is not an ECN account. This is a variable spread account, so you're going to get the VAR. Okay, the spread's wider. Tells me nobody's trading right now except amateurs. Look how wide the spread got. That's normal. That tells me nobody, oh, and then boom, and watch, it'll, okay, so we got dollar strength, and that's probably, my guess is a big number. 236, it's actually not that bad. Thank you, Arve. Interesting, that I don't consider that bad. I guess what, people are expecting way better? So let's, I want to do the bearish confluence here. I would be careful here. I think this is one of those fake out moments where this goes up, not down. Interesting. Really, 230K. What about the revision, Arve? Do we have a revision? Look at that. Look at that. It went up just like I said. Oh my God. Oh my God. Look at that to the pip. That's ridiculous. That's sick. Huh. So as expected is what I would say. 236. FXStreet said 240. Thank you, FXStreet. Yeah, I would expect that is, hey man, not 500,000. So that just takes us to the next target, which is 111. And we're only at 109. I would expect, if this continues up, that we got a good 200 pips between now and next week. The highest projected target is not quite 112. What is it? 111.77. Oh, man, that's sick, though, that price action. Oh, my God. Now the spreads have narrowed again. So we got the new liquidity. Remember before they were much wider. And that just shows. See, I like the variable spread account more than the ECN. I just always have. I'm old school, I think. Because in this case, I can see the liquidity. And I'm not talking about, go to properties and go show volumes. Okay, I'm not really talking about that per se. I can see it in the spread. And narrow means lots of liquidity. Wide means no liquidity. Okay, so let's take a look. Oops. Let me open this up on the other window. Okay. Bring this over. I will give you the non-farm payrolls. Here it is. 236. $3.5. Definitely not on the way to 5.0. There's like no change. That's actually quite negative. That would be dollar strength, I would say. So what I said yesterday at FX Bootcamp is I expected professional services to lose employees, but maybe a service sector like restaurants and hotels maybe add employees. So let's take a look. The labor force participation rate is trending up, which is interesting. More people are looking for work. That's good. So I go back to this, like this to me smells like dollar strength. Was it that one? Okay, it smells like dollar strength anyways. Because even though NFP number isn't as high as it was, it's not improving for what the Fed is looking for. Okay? So that's kind of interesting. Total, okay, the average is 334. So we had a below average month. But that's still a big number for a Fed looking for inflation to come down. That's not disinflationary. Employment continued to trend up in leisure and hospitality. Yeah! But also professional and business service sectors. Wow. Leisure and hospitality added 72,000. Lower than the average. All right. The government added 50,000 jobs. Oh my God. I'd like a smaller government if you ask me. Employment and professional business services continued up. That's huge. Look at that. The government added more jobs than the business sector. Gee whiz, huh? Healthcare added 34,000, lower than average. All right, well, you could argue maybe some of these are like, okay, they're increasing, but at a slower rate. Retail changed Oh, negative 15. Home Depot and Lowe's laid off. Yeah. Retail. Yeah, see, like retail's getting crushed. By the way, I've discussed all of this in my quarterly outlook I did a week ago. More than a week ago, a week and a half ago, I did a quarterly outlook for April, May, June, and all this has been discussed, but I'm just emphasizing that, well, what was discussed was correct. This was all discussed a week and a half ago. So that's pretty interesting. But we look at this and we get this not from the numbers, but through analysis of things like inventory levels. So if inventory levels are going up and orders are going down, then you can surmise that these firms are going to lay off workers. And we were correct in that analysis. Congratulations. Employment showed little change over the month in major industries, including mining, quarrying, oil and gas, construction, manufacturing, wholesale, financial activities. Wow. So, okay, this economy is still a good economy. Okay. Wages are going up. Okay. Look at that. 4.2% wage inflation. Holy smokes, guys. We still have massive inflation. Let me put it in terms that we could understand. Over the last 20 years, we had no wage growth, but we had low inflation, which is the same as getting higher wages. It's just different. So your job might not give you many raises, but every time you go to Sam's Club or Costco or Walmart, you're like, damn, the prices are coming down. Everything's cheap. I can get a bigger TV. Yeah, you didn't get your salary or your hourly wage didn't go up, but you can buy more and more stuff. You just feel richer, which is better because when prices come down, it means your economy is productive. The more productive your economy, the more affordable everything gets because you're more productive. For an example, when you study microeconomics and you're studying whether a factory should increase production, well, one of the things in the model is that in many cases, if you double production, okay, your marginal cost, that is the cost per unit, okay, goes down by 30%. Okay, if you make twice as much stuff, each individual thing drops, your cost of every individual thing drops by 30% because of things like economy of scale. You can negotiate better deals with suppliers and all that kind of stuff because you're buying way more so that you get a better deal. But now we're in an opposite situation where wages are going up, and that's a sign of non-productivity. Now, how do you become non-productive? Okay, well, you do nothing. That's the most unproductive thing. So why, right? You're not doing anything, but you're earning money. Okay? As an economist, I was amazed to see people in Cuba doing nothing and earning money. Doesn't mean they're rich. It's amazing, literally. People, their job was to do nothing. I've seen it where people's job was to set the table at a restaurant at the beginning of the day. And during the day, not one single person walked in and had lunch or dinner or appetizers or a cocktail. Not even one person. And then at the end of the day, their job is to take all the plates and the knives and the forks and the napkins and the wine glasses and the water glasses and put them all away. And meanwhile, you just wait. Okay? Obviously not a very productive economy. And therefore, guess what? What's important isn't the wage. What's important is the productivity. And the higher productivity your economy has, one way or the other, you become richer. Richer in the form of standard of living. You cannot ever have a standard of living that's good if nobody does anything. But if everybody's productive, everybody benefits. So please never, ever, 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 ever be in a scenario where the economy becomes unproductive. So this tells us right away 4.2%. When the economy was booming for 20 years, this was close to like 1%. Less than 2%. So we have double, at least double, maybe triple the normal level of wage inflation, which means somebody's getting money and they're not productive. If they were productive, this would be down. So somebody's got to get fired or somebody better do more stuff. Okay? So anyways, the average work week went down. See? What does that tell you? What does that mean? Are they, okay? Don't think of it as literally how many hours you work. Think of it as productivity. What if what you did was measured in time? So let's say you worked 40 hours a week, but you go to the bathroom 5 times a day for 15 minutes, 20 minutes each time because you got to play your, Candy Crush or something. So you sit on your phone in the stall. And then you take, an hour and 25-minute lunches. And then you go to meetings. And you really don't do much, right? So imagine you worked 40 hours, but you actually, per week, you actually only did 34.4 hours. Now, I've had jobs in my life. Not many. Okay? I've run teams of hundreds of people. And I can tell you, there's a lot of people that only do 34 hours of work in a 40-hour work week. They show up, they're in the office for 40 hours. But you know these people, right? And so just imagine that there are unproductive workers and yet they're earning too much money. And you know it's not fair, right? The people that carry the weight are like, that sucks. You're doing all the work, but that person's getting a free ride. Well, that's not good, right? So what eventually happens? The best employees leave because the managers don't do anything about it. So the best employees leave. And then the company becomes even less productive and eventually goes out of business. If they had good management, they would protect the good workers and fire the weak ones and then recruit and hire new ones. So anyways, that to me is a representation of inflation. People are earning more and working less. That doesn't smell good to me. Okay, and then here's the change. Okay, the revision. Okay, that 500 print is now 475, 472. Okay. February was revised up to 325. Ooh. Okay, so anyways, combined over the last 2 months, the previous 2 months, 17,000 lower than before. Okay, so maybe you can start to argue maybe Fed policy is starting to work. Dennis, that's pretty funny. Yeah. Yeah, a friend of mine worked at this company. I'm not going to say the company. It was a Japanese company, though. I'll say that much. In the Silicon Valley. And this was a bigger company, an established company, and he was used to like high-tech startups. And so anyways, he got hired, and he very quickly found out he had hardly any work to do. So he'd sit there and he's like, dude, like nothing's going on. So he'd talk to his boss. Hey, like, do you have any work to do? And he said, sit down, shut up, mind your own business. So he started like walking around, like literally walking around and looking for things to do. Eventually he noticed a more senior person had stayed at the office late or was in the office at 6 in the morning or something. Anyways, noticed this person actually hustling, and you're like, wow, look at this. So he went over there and he's like, hey man, what are you doing? He's like, oh, I got this conference coming up and I'm struggling with my PowerPoint and it sucks and I'm going to freak out. And he's like, whoa. I'm really good at PowerPoint. By the way, this was in the 90s, right? So PowerPoint would have been new for a lot of people. So anyways, so he's like, oh, I'm really good. I can help you. Why don't you just write out all the bullet points and I'll create your slide deck for you. And he's like, you'd do that for me? And he's like, yeah, I got the time. Well, he did it. And the senior person had a great presentation and was super excited and started mentioning this. Well, I went back to my friend's boss and he's like, whoa, what? You walked around talking to senior executives and telling them you had nothing to do? And then you had the time to help them? So they promptly fired him. Because everybody in the department, and probably the entire company, had created an atmosphere where they're all pretending to work. But nobody was doing anything. And they promptly fired him because he was going to screw the whole thing up. Yeah. You're going to screw it up. You're fired. Get out of here. So anyways, this is pretty funny. And of course, that business, which that company, which used to be really big in multiple, industries, are now gone. And that's what happens. B people hire C people. A people leave the company and the company goes out of business. A people hire A people. If you're a business manager, you should hire people smarter than you, more talented than you, more driven than you, and then you help them succeed. A C person doesn't think that way. A B person doesn't think that way. So anyways, boom, bouncing off the support. Hey, look at your volatility, everybody. Look at that volatility, huh? Ooh, who would have thought? Who would have thought, everybody? High volatility, low reward. Huh? Oh, my gourd. Look at all of that. Now, you might be thinking, oh, somebody's making a lot of money. I look at it like, yeah, either they made a little bit of money and it's irrelevant, or they're losing money. And why? Was it worth the shot? So what I'd rather you do is go through those numbers I gave you, the actual BLS report, the Bureau of Labor Statistics, and you start analyzing it, breaking it down into pieces. Of that report, what is bullish? Of that report, what is bearish? And then notice over time it becoming more and more bullish or more and more bearish. And you use that to understand the lexicon of the market, the zeitgeist, the what market participants are discussing and talking about. Another word would be sentiment. Okay? That's what you're trying to figure out. Don't think good or bad, because as I discussed with you today, good is bad and bad is good, because it's a behavioral finance issue. We're not talking about good or bad in the number. What we're talking about is, how does this number represent the effectiveness of monetary policy with the projection of what will the monetary policy be in 3 months, 6 months. As I said before, the question institutional investors are asking themselves right now is, what will the stock market be doing in September? They don't say 236, buy, sell. No. Does anybody have questions? How can you learn from me about fundamentals? Okay, there are two ways. You can subscribe to Quant Box. Okay, your global macroeconomic quant in a box. Uncover the best fundamental investment opportunities across markets. Our AI-driven analysis of sentiment, inflation, employment, GDP, technical trends, open trade positioning, and seasonality uncover the best fundamental investment opportunities across all of the global markets for you. Okay, another one. FX Bootcamp. For a whopping 88, this is actually a low number. It's closer to 88. I think it's 88 hours of training videos. Learn how to plan your trades, swing trading, Forex basics, principles of price action, introduction to Forex trading, MT4, MT5, fundamental analysis, day trading. We have an oil trading course. We have a macroeconomics course. So I even have to update this. Let's see if I have an account. I never know if I have an account. Let me just show you though, like, here we go. So this is, I'm inside FX Bootcamp. It's pretty. But like, if you go to the Central Banking Fundamentals course, okay, Okay, it's 2 pages, so this is lesson 10. Okay, it's 12 lessons. So we can go here to like the bank accounting lesson number 3. It's an hour and 22 minutes. This one lesson, managing the balance sheet of a commercial bank, is 1 hour and 22 minutes. And this one course is 12 lessons. So this central banking monetary policy course could be 15 hours, just this one course. And all of them combined, access to all these courses is $88 a year. So it says 100 lessons. Yeah, there's 100 lessons. That's interesting. There's 100 lessons in all these courses, and they're an hour each, probably on average. So definitely when I say $88 for 88 hours, it's pretty accurate. Yeah, it's a good price. Okay. How about macroeconomic principles? Okay. I mean, like, these are college level courses. Like, that's the production possibility frontier curve. I mean, should you pay interest on money you borrow from? So we'll go up because the ovens are better. Cool. Like we're literally, I'm not even joking, college level, university level economic courses. Taking the, right? Anyways. Dude, it's good. So those are the 2 places I would start. Did you go to college for economics? I have a macroeconomics degree from Harvard. My master's degree is in financial management. Yeah. Then I went to Harvard Business School to study alternative investing. Then I went to MIT to study cryptocurrencies under Gary Gensler, who now regulates the cryptocurrency industry. No joke. He was my professor. Then his next job, literally like 2 weeks later, he runs the SEC. And then I went to Oxford to learn algorithmic programming. Oh, so yeah, anyways. So you get a little bit of all of that in this stuff. See, look at us shifting the curves and all that kind of stuff, comparing South Africa to Israel. Anyways. So I'll put the links up there. Let me give you the 3 important links of the day. http www.quantbox.co http:// FXBootcamp.com www.tradersway.com. Those are your 3 big links of the day. Cool. Not sure if I have an account here. Do I have an account here? What's the other one? No, I know that's not right. Anyways. Anywho, very, very pretty. So as predicted, we had a big move followed by complete reversal. And it's ugly. It's ugly. Ugh. Okay. So I have the rest of the day and the rest of the weekend to analyze where we are now economically. And now that the volatility is over, I can calmly and intellectually decide what I want to do with the euro dollar versus responding and reacting to a news release. You see the major difference? Right, Peter. But at least we're not caught up in the noise, right? Looks like a simple role reversal so far. Okay, we'll take a look around the world. What else is going on? Okay, so here's the issue. Unfortunately, I can't access my horizontal drawing tool because I've shrunk my... Let's do it this way. Okay. This is support. Okay. I discussed it yesterday in my swing trading group. Okay. And then what is the current trend? Up or down? Well, it's up. So probability dictates, like, if you're going to use technical analysis to analyze the probability, because that's all we really do. Because if it's at support, if you think it's support, it's probably going to bounce. If you think it's resistance, it's probably going to be rejected. Because that's what support and resistance is. Why make it more complicated, right? So if you think that's support, and you believe this is an uptrend, then it will probably, aka the probability, it'll probably go up because that's what it has been doing, and it hasn't not started to do the opposite. Okay? I'm really bad with the double negatives. I'm sorry. Some people are really good at double negatives. I can't even fake it. I think I contradicted myself there. You cannot not start? I don't know. Anyways, up, dude. Okay. Delete. Okay. Higher high. What do you do next? What do you do after a higher high, everybody? Help me out. What would the Wayne do? What should you do? What do you do with price action? Higher low at a roll reversal. Okay, so now you go like this. There's the old resistance, drag it across. There's the projected support. You knew this yesterday. I discussed it yesterday. Actually, you knew it 3 days ago. I discussed it yesterday in the swing trading group. Cool. So that tells you if you're a bull, you get ready to buy right around there, 124. Will it go up? Who knows. But do you know what you intend to do? You never know what the market's going to do. You don't know what the future is. You never will. And there's no indicator. Stop looking for it. That always knows the future. Stop looking for a guru that knows everything. I hope I come across confident, but I don't know the future. I just know what I intend to do. And that's what I want you to do. You don't know really the future, but you've done your analysis and you know what your intent is. If you are a bull, because it's made a higher high and it is trending, you will buy a higher low. Where will you do that? At a roll reversal. There's the roll reversal. And now you're up. And what does technical analysis tell you? Somewhere between 127 and 128, you're going to take profit. That's just what the chart says. You're combining two leading indicators, price action and pivot points, which are helpful if you, since we don't know the future, it's nice to have some leading indicators that might help. Adrian says, would your stop loss go below the swing low? Yeah, it goes below support. Yeah. Which sucks, Adrian, if you only have a 30 pip stop loss, right? You're like, but it's so far away. Now, if you ever get that thought where you'd analyze where your stop should go, and you're like, oh my God, I can't have a 70 pip stop. What does that tell you? Does anyone want to share? You know where your stop should go, but you can't afford it. It's too far away. What does that tell you? Huh? Lower your risk, but why? AB Sports. What I'm getting to is it tells you that you're over leveraged. Okay, so some idiot bumbling knucklehead of a YouTube guru has told you to keep your stops tight because you can't lose much money if your stops are tight. It's the dumbest thing ever. Also, they're only trying to pick up 20 or 30 pips. Do you know why? Because that's all they're worth. So, I'll say it again. If your stop is, you know where your stop should be, but you can't afford it, you're risking too much money per trade. You're using too much leverage. Your lot size relative to your account size is too big. Lower your risk per trade. Lower your risk per trade. Lower your risk. Lower your risk. I don't care if you have 100-to-1 leverage. That's not what I'm talking about. Your account size is small and your trade size is big. No. What you're trying to do is, right? You want to lower your risk per trade and then over time, grow your account size. Why do so many amateurs lose money? Because they're doing the exact wrong thing. Think about it. If you just did the exact opposite, you're probably better off. You're like, why don't I have lower risk trades and try to focus on letting my winners run? Well, oh my God, that sounds like a winning strategy. Of course it's a winning strategy. Lower risk per trade, then you're like, but how do I make money? Well, you can't make money if your trades are only worth 20 pips. Okay? You'll be better off panhandling at the bus station. You'll make more money working at fast food restaurants. Okay? So instead, you need your trades to be not, right? You want them to be less risk, but worth more. So how do you increase the value of your trades? If your lot size is small, you trade positions that last not minutes, but hours, days, weeks. There are people here that have seen me hold trades for months and months and months, and discuss the position months and months in advance, where I know what I intend to do in September, actually the third week of August. I know what I intend to do the first week of August, the third week of August. It's wild. It's crazy. But again, don't mix that up with arrogance. What I'm trying to get across is that with careful analysis, you can develop a logical and intelligent strategy. I don't mean the techniques for entering and exiting trades. That's tactics. Strategy is knowing simply to be a bull, a bear, or you're not in the market. Because not trading is taking a position. Not trading is a decision. So I want you to be focused on, are you a bull or a bear? What I don't want you to do is decide, oh my God, 236 on NFP. Sell. Why? I don't know, but there's a big red candle. Well, good luck with you. Good luck. Okay? I've been doing this one webinar for 17 years. I bet you the person that only trades a reaction to a headline, number is not going to be around in 17 years. Okay? So anyways, lower your risk per trade and let your winners run. So the intention on the short run would be, while we're in here, will it roll over? And over the next week or two, will it head up to target? Okay? Now, if this fails and the end result goes this way, what do you think happens to a bull? Not necessarily become a bear, but certainly stop buying. Right, AB? Yeah, you get stopped out. You get knocked out of break even, you take a small loss, but it's no big deal. Why? Your lot size was low relative to your account size. So you take a loss. But you can afford the loss. It's okay. Why? You're not over leveraged. You're conservative and you're disciplined. Great. Cool. So what you should be doing on a 5-minute chart, right? Hang on. See, I wish I had my drawing tool. I can't grab it because my charts are so small for this webinar. But anyways, let's mark that. That's a little too high. I'm trying to get this flat. It's pretty close to that. Okay, drop into your fiver. And what we're looking for on a 5-minute chart is if there's stability in the volatility. And on your 5-minute chart, it turns bullish. Well, what is bullish? Well, that's your job to decide. Okay? You're the tactician now. Now this is only technical analysis. You notice that there's no strategy on this. You may have already decided that in this zone, for example, okay, you might consider being a bull based on that analysis I showed you. We know if you look way left, it used to be resistance. So now it might, I emphasize the word might, it might be support. It might be a role reversal. What used to be resistance might become support. So we know this is way back on a 4-hour chart and a daily chart. And if it goes up, it'll probably go up for a week and a half, 2 weeks. Take your 20 pips and shove it. Okay, this is going to go up for 2 weeks. If I can't make 200 pips on this, then I shouldn't take the trade. You see, you got to be in boss mode. Why would I demand many pips for a trade? Because my risk per trade's low. So I rely on not getting lucky and making a lot of money quickly. I'm not relying on getting rich quick. I'm relying on my technical and fundamental analysis for creating a strategy. Then I use the charts to say, if I were to be a bull, I would want to buy it down in here. So now I'm all tactics. This is me kicking down doors and putting ammo into targets. And so I sit here and I say, well, if we come down to here and then it does a double bottom, higher, high, higher, low, then my intention is to buy it right here. If we get down to this area and it double bottoms, then makes a higher high, then makes a higher low, then my intention is to buy it. And now I'm scalping because I can put my stop there. I'm risking hardly any pips. Now my stop's only 30 pips away instead of 150 pips away. But now I'm scalping, boy. I'm going to scalp 200 pips or I'm going to lose 20. Right? So now my risk reward, I'm risking 20. I don't know if that's the exact number, but think of the logic. Don't get so specific, right? I'm risking 20 to make 200. That's my value proposition. But if you're risking 20 to make 20, you actually have no value. You're not getting compensated for the reward. You're not getting compensated for the risk you're taking. So if I'm going to risk the same amount, I want 200. You're like, 200 pips on a trade? That's amazing. No, it's not. You're just not doing it correctly. What's the most amazing number you've ever heard for a month of trading? Most people think in hundreds. I've proven to many people here that they can, not in a normal month and all that kind of stuff, but I've proven to people here that you, under right market conditions, you can conceive of 10,000 pips. To me, at 300, AB says 300. That's one trade for me. If all you make is 300, you'll never make it. Because the only way to make any real money now is to jack up your lot size. You see what I mean? So we got to change your 300. Let's say the first start is 1,000. You need to make 1,000 pips a month. And then the next level is 2,000 pips. Okay? But many people here have taken an exam, actually, a trading exam with me. Okay? A simulator with real data. And the minimal acceptable performance, the passing level, the passing grade is 10,000 pips in that month. Now, to achieve that, you have to get obviously the price action and the technical analysis and all that. You got to get it correct. And then, of course, you have to be able to trade properly, and you need to compound. It's not one trade for 10,000 pips. No, you have to make 20 or 30 or 40 trades. But trading not all over the place, long, short, long, this, that. You're random in a random market. No, that ain't going to work. But instead, compounding. The most powerful force in the universe is compounding. It's the only way to make 10,000 pips. Have 30 trades, 50 trades. Okay? Has anyone here taken that exam? Where the minimal pass is 10,000 pips. And the point isn't the get rich quick, like, oh my God, I could be driving a Lamborghini if I could do that. The point is to smash your concept, destroy your old mind of Forex, where you make 300 pips in a month. So you do the math, and you have to have huge lot sizes, massive risk to make any real money. I'm going to put 10 standard lots on this trade and make over 25 pips. That's the dumbest thing. It doesn't even make logic, but it's not your fault because you don't know. You're new, and you're listening to some guru on YouTube, and you're like, well, that's what they do. I guess that's how. And they drive fancy cars. So that must be how you do it. No. It's amateur. No. So the only goal of that is to just smash the old way of thinking. And then I want you to then really ponder and say, holy crap. Well, if that's an extraordinary month, that's an extraordinary month. But for AB that says, okay, you're supposed to be making 300 pips a month, I'd rather you really sit down and say, how can a really, really good month, how can your trading behavior lead you toward not 300 pips in an extraordinary month, but 3,000 pips? How about in a good month, 2,000 pips? How about in a boring, benign month, 1,000 pips? Well, how would you need to behave differently to achieve that, AB Sports? And you might say, oh, well, I'm going to have to think longer term. I'm going to need to understand the fundamentals. Each trade, I'm going to have to lower the risk because I'm going to need wider stops. And then I'm going to have to let them run. So an average trade is worth somewhere between 100 and 300 pips per trade, not per month, per trade. And yes, you're going to have lots of break-evens and you're going to have some losers, but your losers are going to be way smaller than your winners, and you're going to let your winners run. And all of a sudden you start going through and you're like, dude, 1,000 pips a month is only like 3 or 4 or 5 trades. And you're like, but you're making 50 to 100 trades a month, right? And you're like, no, I only make 3 trades a month. Well, it ain't going to work. And I always lean on just do the math. If you only do 3 trades a month and you're unlucky on 2 of them, you've just lost your month. If you make more trades and better trades, what you're trying to do is reduce luck. Reduce it to the point where there's no luck in your trading. You're either right or you're wrong. You see? Now, volatility, when you're in and out quickly and the spreads are widening and you're trading the news and, it dropped 50 pips and rallied 50 pips, well, you can get unlucky because you're trading in very risky scenarios. What we're trying to do mathematically is remove all luck. Now you're either right or you're wrong. Well, what does it mean to be right? you've done careful study and analysis of macroeconomic data comparatively, and then you open up a chart and you apply your technical analysis to decide the time and the price in which to execute your trade. You've already decided what trade you want to do and what direction you want to do it. You just don't know the price and time. Well, that's what a chart does. So then you open up your chart and you wait for your proper price and your proper time. And then you trade it. What's the likelihood that you're wrong? Well, it's reasonable. But you're probably right because, right? An honorable general wins because many plans were made. Sun Tzu said that thousands of years ago. Many plans were made. The execution of the strategy is just what you do on your chart. What's the big deal? Okay? AB says, so you use more higher time frames for swing trading. Well, yes and no. Okay, my book that I wrote 20 years ago, AB Sports, is called Strategic and Tactical Forex Trading. So there's strategy, and that's one whole thing, strategy. And then the whole other thing is tactics. So they're not combined, they're two different things. So to do a technical strategy, I mean, I prefer you start with fundamentals, but let's say you don't understand fundamentals. Okay, fine. Start with the technicals. What is the pound doing on the 4-hour or the daily? Is it bullish, is it bearish, or is it neutral? Okay? If it's been bullish and you're a trend trader, then your whole strategy is based on the trend will continue. The trend is your friend until it lies to you, betrays you, and stabs you in your back. So your friend is your trend. The trend is your friend. So you might look at a daily chart or a 4-hour chart, whatever. You look at it and you make a decision, bullish, bearish, or neutral. If it's neutral, stay away or prepare for a reversal. If it's a bullish trend, buy the dip. Done. I'm serious. That's it. You're done. Most amateurs do not have the capacity to do that. They just don't do it. What's the 4-hour or daily trend? I don't know. I only trade the 5-minute chart. I only trade the 15-minute chart. All right, you will be destroyed. It is futile. Irrelevant. Right? You got to, I'm quoting the Borg, by the way, right? Resistance is futile. You will be assimilated. Right? So you look at a 4-hour and you say, oh, bullish, I'll buy the dip. Well, at what price and at what time? Okay? So I get to a scenario where I've already done that for you on this pair. And by the way, I can tell you, based on seasonality, this is probably not the best trade to be looking at right now. I'm just doing technical analysis. So there's flaws in everything I'm showing you right now. I can find a better trade because I have more information. But anywho, I look at that and I say somewhere in here, based on my higher time frame analysis, I'm a bull. Okay? And that's it. Done. So now I look at this on a 5-minute chart. Is this bullish? No. So what should I do? Buy it? No, it's not bullish. It might continue falling. Probably not, but it could. So I wait now until I'm convinced this is bullish. And then I buy the dip. And now what? I understand that this area in which I bought this here, this I intend to buy here, for example, if I'm right, there's a reasonable probability this goes up 2 or 300 pips. So my intention is to enter the trade. My intention is to let it run. And maybe on Monday, I move my stop from down here to higher up to maybe break even. And then I let it run. Potentially for a couple of weeks. That's important because my risk on this trade will be extremely low. So to make any real money, I'll have to let it run. So how do I know that it's going to run? Yes, you got it. All of a sudden, click. Suddenly you've asked the right question. Well, how do I know it's going to run? Yes. That's called value creation. You're trying to predict the future. You're thinking about next week. You're thinking about the rest of the month of April. You're thinking about the quarter. And to get that right, you're thinking about the Bank of England. You're talking about the Fed. You're talking about risk on sentiment. Oh my God, you're talking about seasonality. You are now suddenly asking all the right questions. And you have to be that good if you're going to take low risk per trade and let your winners run. And that's what you're supposed to be doing. And the guru on YouTube that is dancing with pretty girls in bikinis on a yacht or leaning on his yellow Lamborghini or showing you his fancy watch, they're full of crap. They're children. So now you got to ask the right questions, and that's why I created that examination to just shatter your mind. Shatter your mind on how to think about trading. You need to make more than 300 pips a month, without a doubt. Okay. Cool. Okay. So, for example, when I say you could probably find a better trade, one of the things that I have in my back of my mind is this. Let me try to do this prettier. Okay, I'm looking at this right here. Oh, let me do it again. So you got to see your label, right? There we go. What does this mean? Institutional traders are positioned more on the bearish side for the Great British Pound. Institutional traders don't want to buy the pound, even if the pound is technically bullish. So what if I got a similar trade over here? What if euro was doing the same as the pound on the chart? Where you start on a high time frame and it's bullish on a high time frame. So you say you want to buy a dip and you're like, at what price and what time? So you find the price and you're like, okay, that used to be resistance, now it's support, great. Now you drop into a 5-minute chart. You already know the price, now you just need to know the time. When does it produce a reversal pattern, if at all? But it probably will. So when does it do it? And then when you do it, you've answered the time. But also knowing institutional positioning, what does a hedge fund do? Well, a hedge fund, if they saw the two charts and they were exactly the same, they would go long the euro dollar, but they would be less inclined to go long the pound dollar. Most positions are short the pound on the institutional side. Now you might back off and you're like, wait, whoa, hang on a second. What? You're trading with hedge funds and not against hedge funds? I'm like, yeah. You're like, Wayne, you know the institutional positioning of hedge funds? Oh, yeah. Well, every subscriber to Quant Box does. And so now I can make better decisions now. If pound dollar is going to go up, oh God, euro dollar is going to go up more, probably. Now, anything could happen, but I can see where the money is. This is not a sentiment gauge. This is the analysis of open positions. Oh, God. Okay. Now, the cool thing is, like, when you look at this, yen is by far the weakest. I think that's going to change. How do I know that? That's my job. I have to predict the future. That's it. Not just because it's at an extreme, but because of my analysis of the Bank of Japan and my analysis of seasonality. Cool. But if you were to compare this, you'd like, well, institutions want to buy euro and they want to sell yen. So you could just take a look at USD yen. Now, it's neutral. Now, why would it be neutral? Oh, sorry, I picked the wrong one. What was I going to do? Euro yen, sorry. It's neutral. Because I believe, okay, things are changing. Okay? Things are changing. This is not the right time of year to be going long euro yen. Now, it could go up, and technically it is up. See, this is just technical analysis here. And remember the math I was sharing with you earlier today? You want to calculate the mean. So you'd calculate the average point here to here, which would be here, and then the average point from here to here to here to here and to here. And all of a sudden you create all these average points. And you get yourself into, on average, okay, you get a move like that. That's step one. Calculate the mean. Step two, look at the rise over the run. This is the run over time and the rise. That's the slope. Okay, so now you have the slope of the mean. Then three, calculate the high variance, the low variance, the high variance, the low variance. Okay, so that's the variance. Okay, and then from that you take the square root of the variance and you get the standard deviation. By the way, I hope you're loving this. Not even spelling it right, am I? Deviation. It's hard. It's so hard to even just draw it. I'm spending all my focus on drawing the letters. Okay. So now you can calculate, you take the square root of the variance and you get the standard deviation. And check this out. Because you know the standard deviation of the variance, you can project using the project forward using the slope of the mean and the standard deviation of the mean. You can project one standard deviation below the mean. I'm going to have to delete this. Okay. One standard deviation below the mean with the same slope of the mean, and this standard deviation above the mean with the same slope of the mean. And now you can project, if nothing else changes, what price we will be at for euro yen in the next 7 days. If nothing changes, if the data set continues on trend. Because you have best case, okay, blue is best case, black is base case, pink is worst case. And now you have a technical model projecting 7 days in advance, 7 trading days in advance. How many people love that? How many people love that? It's not an opinion anymore. It's quantitative analysis of quantitative analysis of the technical charts. How many people love it? The next thing is, what does this pair tend to do in April, May, June? Well, January to February to March to April to May to June to okay? Sort of mediocrity. That's what's happened over the last 5 years. Well, we got a lot of COVID-related stuff into that, right? So what typically happens? In blue down here, we have the 20-year norm for euro versus yen now. So February to March, March to April, April to May, May to June, June, July, June. Oh. So what does it tell you? If we're in this period here, between here and here, what does it tell you? That yen, do you remember the yen when I showed you institutional positioning? Everybody and his mother was short Japanese yen, and everybody was long euro yen. That's the past. That's where they are now. Does it tell you what they're going to do 3 weeks from now, 5 weeks from now, 7 weeks from now? No! That's passé. So I'm thinking ahead because that's my job, to predict the future. And this says using 20 years of data, pretty soon, right around now. So somewhere in the next 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks, traders are going to start taking profit on their euro yen. Euro yen's more likely to come down. Now, it doesn't mean they're bearish. It means they start taking profit. They get out of their short yen position, they get out of their long euro position, and they go find something else to do with their money. That's my job, to understand that that's what they're thinking about today when non-farm payrolls came out. They're not thinking about like, oh my God, look, 236. That's not what an institutional investor thinks about, cares about. They're 3 months from now. They're 6 months from now. They're a year from now in their thought process. And so what they're thinking about now is, well, pretty soon it's going to be time to get out of this euro yen long position. And QuantBox already has given you the heads up. Whoa, 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 whoa. You're bullish here? Well, be cautious. Okay, be cautious. Be cautious. Gorgeous, right? Be cautious because, oops, that's the ranking of all today's trades, by the way. Be cautious because okay, at the very least, this might change soon. So you're looking at reality. This is a screenshot of reality. This is how institutional investors like hedge funds are positioned right now to turn a profit in the foreign exchange market through speculation. There's no hedgers here and all that kind of stuff. This is pure institutional investors. But that's about to change. So I'm thinking forward. Okay? So I'm thinking maybe euro yen long isn't the best thing, and maybe pound yen, going back here, oops, as I was showing you before, pound is neutral to bear, actually more bearish. So if yen suddenly spikes and euro stays strong, because remember, it's the strongest, then well, shoot. If yen goes up, it's going to kill the pound. It's going to kill the Aussie. It's going to kill the Kiwi. Uh-huh. See, now you're thinking forward. Isn't that amazing? Thinking forward. I wanted to get to a different version of QuantBox. The Pro version has more tools. And I wanted to show you a page on the Pro version. Okay, logging into the database. Remember, this is a database. This is not a website. It's a database. It's grabbing all this proprietary data, well, public and private data, and doing the calculations. What I wanted to show you is this. How amateur traders are positioned. Isn't that cool? Okay, retail is amateur. We're all retail. And here is the institution. Again, what we were looking at is institutions. 91% currently are short yen. And 75% are currently long euro. So if you were going to buy today, wouldn't that be the better trade? But what about next week? What about next month? Whoa. Well, that could change. Okay. Check that out. 87% of retail traders, not hedge funds, not institutions, retail are short Euro Kiwi. They're short. But we just learned 75% of hedge funds are long euro. Okay? And 87% of retail traders are shorting euro. Do you see the disconnect? Oh, God. That's why you get smart money, dumb money. Is the typical hedge funds are considered smart money, retail is considered dumb money. I don't like that naming, but what it means is retail traders are much shorter term. So maybe on a 5-minute chart or a 15-minute chart, maybe today that might be the right thing, but on the long term, it's the wrong thing. And it takes a while. Retail gets in late to a trade, they get out late to a trade, and that's why the best retail traders are break even, because they're late in and late out, or early in or early out. It ends up being the same thing in the bigger cycle. Meanwhile, an institutional trader, like I'm trying to teach you how to trade much more institutionally, and I'll leave you with this thought. We looked at the longer term, and now we know this isn't even the best trade. You should probably be looking at another trade. But let's say you didn't have that alpha. That's me. That's my alpha. I generated that value. But the next thing is you still technically want to buy this. We looked at it on a 4-hour and a daily. We determined the price in which we might buy, and that's this zone. That's the price, but we don't know when to buy. So what I said is, well, if we get down here and then it makes a higher high after a double bottom and then a higher low, then, see, I'm answering now then. Then meaning time. Okay? The price I've determined with this red line, the price in which I intend to buy is somewhere in this zone. The time in which I intend to buy is if it makes a double bottom near this zone or in that zone, then makes a higher high, then I'm going to do a higher low, and that will be the time I buy. Drop a stop, take a walk, 200 pips or bust. I prefer 300 pips, but if this trade only yields 200 based on technical analysis, then that's all I can ask for the market. Cool. That's it. I'm spent. We're done. I thought I was going to end this webinar an hour early. I'm only going to end it a half an hour early. The reason for that is many of the markets are closed today due to Easter. So, I hope you have a nice weekend. Thank you for being here. Again, if you need a better broker, I highly recommend tradersway.com. If you want to learn how to do technical analysis, or you want college level courses on monetary policy and macroeconomics and all those things, or you want to learn about price action and pivot points, that's FX Bootcamp. It's $88 a year. And then if you need, if you want artificial intelligence to gather, organize, and rate economic data for you, right? I recommend my company, Quant. It's good stuff, I'm telling you. And by the way, the trial, let me go all the way down. The trial is $8, dude. Come on. The trial is $8. Peace on earth. May the pips be with you. May our profits be above average. A round of applause for our moderator. Nothing moderate about our moderator. We have extreme moderation here at FX Street. So thank you for moderating better than any moderator has moderated before. And thank you everybody for, 2.5 hours of your time. So I'll say it one more time because it's always important. Peace on earth. May the pips be with you. May our profits be above average. Thank you, FX Street. Cheers.